Varun, thanks for being here, man. This is great.
Thanks for having me, Christian. Appreciate it.
Yeah, of
Glad to be
course.
here.
I always love chatting with you about everything. We've had amazing discussions over the years about history, about technology, about economics, about organizations. And I thought, given your current role as a venture capitalist, it'd be awesome to talk about the broad umbrella of investing with you and finances in general, and eventually getting to your bread and butter, which is VC. Um, so why don't we get started with a little intro question? Um, what is investing?
That's a great question, Christian. Um, I think investing is the activity of putting some resource to work, locking up that resource for a certain period of time, and then in anticipation of some kind of return in the future. And so people often talk about investing in relationships, right? They spend time. That's the resource that they're putting into it. Now, ironically, time is you invest time, and that's it takes a certain period of time for that relationship to build and mature, and the payoff that's in anticipation is some emotional reward, some satisfaction, some potential intellectual learnings that you get from the friendship, just general good cheer. But investing could also be something like investing in a company, basically putting some dollars to work to buy some percentage ownership of that company. This is equity investing in anticipation of the value of that ownership growing over time, and then you potentially being able to do with that something with that, you know, appreciated ownership stake in the company. So I think investing fundamentally is putting some resource to work in anticipation of some future payoff or return, whether it's financial, whether it's emotional, whether it's intellectual, or something else.
And fantastic, because I wanted to keep it as broad as possible, and I think you've touched on the key points there of relationships, companies, and even more sort of generalized, financial products. This could not just be companies, but it could be like a bond or a savings account, or it could take many different shapes. But I love the framework that you're putting up. It's like locking up resources to get something in the future. And different kinds of investments have different kinds of profiles in terms of what you can expect from the return as it happens over the years. And there's another notion there that I think is key to address pretty early on in the conversation, which is risk. And the fact that when you're locking up these resources, you're taking some risk by choosing to allocate them to that particular goal as opposed to something else. Um, and this could go into like time is, I think, maybe the best example, because we all have roughly the same amount of it, and we're all roughly equipped to sort of allocate our time. But the way those activities can pay off in the future is very different. Like I could dedicate my time 100% to my career. I could dedicate my time 100% to my relationships. And they have different profiles in terms of the rewards that they yield and the risk that they incur for me. So you want to talk about how you think about risk in this context?
Yeah, it's a great question. I think risk is a really good question because I used to be a data scientist and machine learning engineer at a company called Affirm, where we were providing loans to consumers at the point of sale. So say that you were at Peloton.com and you wanted to buy a Peloton bike. At the point of checkout, you could basically ask Affirm for a loan. And then Affirm would basically take into account information on you as a user using your credit report, take into account information about the bike. Say, it costs something like $4,000. And then Affirm would basically put all this information into an underwriting engine or a machine learning model, in more technical terms, and then basically try to assess the likelihood that a user would be willing to repay this loan. And so the way we thought about risk for something like lending was, we're going to get some small amount of return. And for that small amount of return, we expect a very small amount of risk, right? And it's going to be, dispersed over a short time horizon, call it 12 months, 24 months, 36 months, 48 months. And so for something like a $4,000 Peloton bike, right, this is fundamentally debt investing. Maybe we could get a few $100s of interest over that 12-month, 24-month, 36-month time frame, and maybe a few $100s of fees from Peloton.com in the form of you know um, transaction fees. And the risk that we would expect would be something like a 2% default rate, right? And
Mm-hmm.
so that's debt investing fundamentally, where the paradigm is there's a very small amount of return, a very small amount of risk over a very short time horizon. Now, on the other hand, today I invest at a venture capital firm called Caffeinated Capital, and the risk profile and the return profiles are fundamentally very different, right? We're equity investing at the earliest of stages, where we're say, giving a company a few $100,000 to a few $1 million at say seed stage, and you know, startups are very, very liable to fail. You probably expect that 95% plus startups fail, as opposed to say 5% of startups fail. But the anticipated payoff is that, conversely, that $500,000 investment you make or that $1 million investment you make can potentially 100x or 1,000x over a significantly longer time frame. And so I guess the way that I might think about risk ultimately is that the more risk you take on for the longer time frame, you should be able to get higher return for it. Otherwise, why would you take that risk? You should go take some other risk that has a better payoff or has the same payoff but over a shorter time horizon.
No, and I think and there's a basket of possible investment opportunities that range from very low risk to very high risk. And we saw like this incredible economic phenomenon play out over the past few years, where the markets were so heated up and melting upward, because of all the capital that was injected into the monetary system, that it created this, I don't want to say distortion, but it created this warping of the natural risk curve that happens between what are traditionally known as more conservative safe investments like treasury bonds, that were yielding basically nothing, to and if you're not getting returns on the safe stuff, you know, financial institutions are still, fiduciaries for their investors themselves, and so they still have to return returns. And so it created this movement from, more conservative investments toward riskier investments, including like the crypto boom that we saw a couple of years ago, where it was
Yeah.
like, this frenzy for um, um, toward the riskiest of all possible investments. There's, you can't regulate that stuff, or like regulatory agencies are still like trying to remotely come up with a framework around it. And there's other stuff in between there too, right? So there's like VC is traditionally like one of the riskiest asset classes ever. There's stuff along the way there. There's like real estate, which is, much more conservative, much more predictable, much more on the fixed income realm of things. And it has its own, it's definitely riskier than buying a treasury bond, but it's somewhat more stable than a company that aims to do something that's never been done before. Um, so what is your thinking around that spectrum of like the stuff in between the very conservative stuff and the very high risk, high reward stuff that you're in now?
Yeah. Obviously, from a personal perspective, I find myself simultaneously intellectually drawn to both sides. The full spectrum, everything from, um, being able to understand, like the private credit market, and like as like a non-bank lender, being able to underwrite companies and their financials, public companies or companies that are not public, but like are very mature and have a lot of financial data you can use to underwrite them. Um, and to provide them some type of instrument that can help them grow or enter a new market or do something that they can't do today with their current funding. I find that intellectually interesting. I also am obviously very intellectually interested by what I do in venture capital, where you're basically giving someone a very small amount of money to innovate in some capacity, right? Commercialize a new technology, develop a new technology, um, and try to basically like 100x or 1,000x the value of their corporate entity in like a 10-year time frame, and then potentially create a company that can stand on its own two legs in the public markets, and generate a lot of value, and really like drive a lot of impact to, society. I think what I tend to think about when you mention the spectrum is, I have to raise capital from limited partners in order to be able to invest it in startups. And, these limited partners range from, family offices of high net worth individuals to multifamily offices that represent many wealthy individuals to university endowments to, pension funds like the Ontario Teachers Pension Fund or pension plan, or CalPERS, to large, insurance companies that have basically a lot of capital that they need to deploy. And, almost all of them basically create a portfolio, like a basket of assets that they try to invest in to generate a target return, right? And that target return is going to vary on the basis of what type of institution you are and what type of capital needs you have on an annual basis. Like, for example, I spoke with an endowment recently that basically said, look, I'm responsible for, north of 20% of the annual expenses of my very large university. And so I need north of 20% distributions from all of my managers on an annual basis. And so that means, in the abstract that they need to be able to liquidate north of 20% of the net asset value of, that's invested out of their endowment on an annual basis. And so that creates a lot of pressures around, are you generating that type of return every year? Are you generating that type of return in a way that's consistent and predictable enough? Are you also generating that type of return in a way that's liquid? And so all of these questions and that return profile are going to shape the way that endowment thinks about allocating its endowment into different asset classes. And so, venture capital will be certainly a very important aspect of what they do in order to basically bound the upside because it has the highest, potential for, IRR net of fees after you, like, assuming that you invest in like 90th percentile performing funds. Right. But like ultimately a lot of their portfolio is going to be invested in much more predictable, much more liquid, much more cash flowing assets that they can just use to basically, fund university expenses on an annual basis. And those are things like, fixed income, potentially a bunch of just pure investments in the S&P, certain types of public investments, real estate. I mean, I've met a manager that I think invested in, like ship cargo boxes, in China, which is a niche I've never heard of, but it's a real one that provides a very consistent return and a very high return and is therefore very, very attractive to LPs. Might have some tail risk, just like real estate has a tail risk in the form of like the Great Recession affecting real estate prices. But anyways, that's kind of how I think about, the spectrum. You ultimately are trying to create a basket depending on like what your capital needs are on an annual basis if you're running some type of portfolio.
Yeah, no, and I think that was great, Varun, because it covers a lot of the stuff that I think is hidden behind a very thin layer that most people don't ever breach of how financial institutions think about money and how money is deployed into entities that we interact with every day. Things like, why do insurance companies have a certain behavior profile? Why do tech companies have a certain behavior profile? And they're all sort of like fitting into these roles that are the risk weighed return roles that the financial institutions that back them assign to them. And so, and I think that's really, go for it.
The thing that I want to, the thing that's interesting is like, ultimately, like all like entities are in the business of capital generation, right? In some capacity. And it's most obvious if you're like a bank or you're like a lender of sorts, right? Like you have a base of literal capital that maybe you borrow or you have on hand and you like put it to work by giving it to people or other companies and they're supposed to pay you back at a certain clip with interest. And so you're literally earning like, some interest on your capital base, and it's appreciating and generating further capital that you can put to work over time. But insurance companies do the same thing, right? They receive a premium to cover some type of risk, and hopefully the premiums that they receive on an annual basis outweigh the losses that they incur when some workers event or some climate event occurs. And so, they're generating capital over time. But technology companies also do the same thing, right? They borrow money, or they get money, on the on the public markets or in the private markets if it's a venture scale technology company, and their job is to generate capital, right? Whether that's literal financial capital in the form of future revenues, or current revenues, or in the form of intellectual property, or in the form of networks, or scale. Like, everyone's ultimately trying to generate capital,
Hmm.
by getting money, borrowing money, or selling equity for that money in some capacity. So I don't know, just kind of mentioning that.
No, 100%. Even nonprofits, even universities or 501(c)(3s, the way they think about money is they raise money, sure enough, and that money is going to be deployed to what we would think of not necessarily capital generating activities, but maybe just not financial capital generating activities. But they still think of it as they take the money that they raise, they put it into an endowment, and that endowment gives them some return on their investment, and that's the money that they use to deploy for their business objectives, right? So they think like they're very financially literate, especially the very elite institutions, we often don't think about them in that way, and I think that the risk weighed spectrum of financial possibilities is huge in order to think about just how the world works and like the configuration that our society takes, but also our role as participants of it too. And so you think about like your 401k, you want your 401k to be very safe, but you think about, other types of investments, maybe, you think of like examples in movies of like friends helping out other friends to start a restaurant or something like that. That has a risk profile too, that involves many layers of risk that, are calculated into the transaction. Um, and which is honestly, like if we were to think about investing in a friend's restaurant, that is much riskier in my mind than
Huh.
what you do, which is like, even though in the grand scheme of things, um, it's a much more proven business model. It's a much more everybody knows what a restaurant is, but it has a capped upside. At least as if we were to think about a normal restaurant, it's not going to make billions of dollars in revenue. Um, Whereas what you do, you sit at your desk and you get companies showing up to you and telling you about how what they're building is going to radically change the world. And oftentimes you have to be in a position, or I mean, venture scale startups have to be in that position because they have to be 100x investments. They have to be or 1000x investments, right? Um, there's another layer there, which I think is like transitioning the conversation a little bit. That is, these types of opportunities that you see are qualitatively incredibly different. Probably one to like they're each very different from each other. Um, so how do you think about risk in a world in which you're faced with different visions of the future, and you have to think about risk in terms of allocating the capital that you're entrusted with to essentially people who have to manifest that vision into reality?
Yeah, it's a great question. I think in very crude terms, the principle that I always use is the juice worth the squeeze? Um, or yeah, is the juice worth the squeeze? And a good example of that would be like there are a lot of companies that are trying to decarbonize certain parts of our economy, or like petrochemical value chains, oil and gas value chains, pharmaceutical value chains, and if I think about like the risk profile involved with a venture style endeavor there, um, say producing sustainable aviation fuels to decarbonize like aviation, um, you meet like a lot of incredible entrepreneurs who are building technologies to do this. That being said, a lot of these endeavors are very capital intensive. They're trying to generate new technology, professionalize that technology, demonstrate a first of a kind capability to actually manufacture those sustainable aviation fuels given the new technology or like research and development process that works. And then they need to scale the manufacturing of that capacity in order to be able to serve, big companies like, United or American or Delta. And then ultimately, there's a lot of downward pricing pressure on aviation fuels because consumers generally don't want to pay that much money for airfare. And it's also, it's not a fully regulated market, but there are regulations out there that, and just a lot of scrutiny from a federal, perspective. And then there are so many companies that are trying to generate sustainable aviation fuels such that it's like, is the juice worth the squeeze? In terms of all the R&D, all the manufacturing, all the investment to then, produce what might ultimately be a commodity. Now, I could be wrong, right? And that's part of what makes venture and technology investing and venture endeavor so fascinating, because very, very smart people will all differ, right? And have very different opinions on the same, type of opportunity. And I think that's, where returns are ultimately generated. Like, I could be completely wrong about this. And someone else could make a lot of money by investing, or building in this space. But fundamentally, I think about it in terms of, is the juice worth the squeeze? So certain risks that you might take on, right, to be a little bit more abstract, like team risk, right? Have these founders who are going to have to build together over the next 10 years, 15 years, 20 years. Have they actually, are they going to work well together? And sometimes that's why, people tend to gravitate towards founders who have worked very, very closely in the past. Another risk that you might take on would be, like market risk, right? People often talk about is the total addressable market, for this endeavor large enough, right? And I think, the way that I characterize something like sustainable aviation fuels, 10 or 15 years down the line, is sort of like a nuanced example of this, because you might say, well, the total addressable market for aviation fuel is probably massive. But I doubt that, there are going to be, only 2 or 3 players that dominate the production of sustainable aviation fuels, just like, there aren't 2 countries that dominate, the production of oil and gas, today. If there are 10 people that dominate, the production of sustainable aviation fuels, and the market is equally split amongst the 10, is that, would that justify the investment that I'm making? But there's also a world of thought that basically says, especially at the earliest of stages, you can't think of risks in that way because the future is so unknown and the future is predictable. And instead, what you should just do is back the smartest people who are going to run the hardest at a particular problem, and just give them a very small amount of capital and see what they can accomplish with it. And then basically take on risk in a different manner, more of like an iterated games type of manner, and basically calibrate the amount of capital that you deploy into an endeavor as things get de-risked, right? And so what I mean by this is, if you have a fund that allows you to invest at different stages or throughout the life cycle of a company, you might be willing to give someone a very small amount of capital given the small amount of work product that they've generated. But once they generate more work product, you can actually invest more capital into them because arguably they've de-risked certain things, and therefore the risk profile of that subsequent investment is lower than the risk profile of the original investment. But you also have to then think maybe the return profile is going to be a little lower because the subsequent valuation of the opportunity is going to be higher than it was when it was just a nascent thing that had no proof points. So I think people think about risks very, very differently ultimately in venture. And there are certain risks. I think every investor ultimately either implicitly or explicitly decides what risks that they want to take on. And I think it's better to be explicit about the risks that you're willing to tolerate and those that you're not willing to tolerate, as opposed to be like, implicit about it. Um, I don't know. That's like a little flavor of
That's
just like
amazing.
how I think about risk.
The aviation fuel is a perfect example, and like when you said the thing about like y- have being forced to think about the idea that you're investing in something that has to go through this incredible process of incredible amounts of capital consumption and allocation to then become a commodity. I was thinking of like the personal computer as something that went through a similar journey, and companies had to, even though they created commodities, they still had to figure out a way to maintain premiums and maintain brand status and maintain, uh, you know, um, tactical advantages such as supply chains and distribution networks and whatnot. And so, like like you could, there's nuance in these discussions, right? In these interpretations of risk, um, and and it's just a great example because it's also like I think it also blends all of the spectrum of the stakeholders that are involved in societal organization. Like, there's a mandate from the big financial institutions that, we're going to decarbonize and this amount of money is going to be allocated to decarbonization. And so it creates these incentives for people to work in these spaces that then, like will have to, interface with the current status quo and have to figure out what that is. Um, you also got me thinking about risk and the idea that the risk profile of subsequent investments has to be lower. I came up with a silly example of fashion. Like a bold fashion choice is a risk. You
Huh.
might turn some eyeballs and be like, "What is that person wearing?" And you see this in like the high fashion world a lot. And eventually some of that stuff like trickles down to the mainstream, and like some things like become mainstays of culture. And by the time you find yourself purchasing a pair of Jordans, you're not really taking a risk. In fact, you're riding the coattails of the people who assumed the risk at the beginning. um,
Also in that example, like, you mentioned the consumer not taking on the risk of like, you know, buying some Jordans and then wearing them and then their friends making fun of them. But there's this like intermediate risk of the actual brand that's investing in marketing, partnerships, its supply chain to actually be able to like manufacture, a bunch of these products like in advance of consumer sales. Because they think that to some extent, there is consumer appeal for that particular product, given the trickle down from, you know, I don't know, I'm currently in Soho, so some like
mm,
fashion event that happened in Soho and throughout the country that maybe like de-risked a certain type of product or brand. Um, and so I don't know. I'm just thinking like who's actually taking on the risk in this case, or who's taking on what kinds of
mm.
risks in the case of fashion.
Oh, totally. And I was thinking more of a like from the perspective of a consumer who's investing their resources to buy clothes that make them look a certain way. And so they're taking the risk of, oh
Right.
wow, those sunglasses, or with some whatever it may be, Um, and then, okay, so risk can take many different shapes, and so let's talk about team dynamics a little bit because you also don't have that much time before you make the investment to meet with founders to get a general idea of the feeling for the team, their expertise, to vet them, to vet the problem space. Like you're doing a lot of your R&D yourself to figure out how their story matches your story as you're compiling facts about the world. How do team dynamics, relationships between founders, how do you think about analyzing that?
Between within the founding team.
Yeah.
Yeah, this is it's such a great question because you're really getting into this blend of facts and then um, like subjective nuance. And so a good example would be, one of the questions that I often ask a founding team, if there are multiple founders, is, how are you splitting the equity in the company?
Mm.
And typically you'll hear folks, say there are two founders, you'll hear folks who say, "Oh, we're splitting it equally because we're great friends, or we just we equally weigh ourselves." And you might expect that that's like the quote unquote right answer, but sometimes you'll hear folks who very rarely they might say it's unequal, and it's unequal by a small amount because it was one person's idea and the other founder joined maybe a couple of months ago. Um, and so there's a layer of, is the explanation good? There's
Hmm.
also a layer of, are they transparent about it? There's also a layer of, if both of them are in the Zoom meeting with you and one person's talking and you see the response of the other person, uh, you know, is their facial expression sort of positive, or is it consistent with what you would expect it to be, um, given the nature of the equity discussion? Um, I can think of plenty of companies where the equity allocation between founders was extremely unequal. To start with, many incubations, right? Like I'd imagine that Anduril had like a fairly unequal, equity distribution from the get go, amongst like the four or five co-founders. And Anduril's now, I think north of $5 billion from a private valuation perspective, and will be a public company one day, and is aiming to be like the next defense prime at like a 40, $50 billion market cap. Um, but also founder breakups happen all the time, right?
Hmm.
There are plenty of companies out there where a founder left fairly early on, and that company is still doing exceptionally well. Um, and so, like a good example would be Scale AI. I think one of the
Hmm.
co-founders left after within 2 years, and the other co-founder is still CEO of the company and is driven the valuation of that company. I think north of $10 billion. So I guess like to back up a bit, team dynamics I think are can be really tricky to read into because you have to basically dispel the conventional dogma around expectations. Like some firms want solo founders, some firms want to see multiple co-founders. Some firms want to see equal equity splits. Some firms want to see unequal equity splits that directly reflect, um, you know, like the facts on the ground in terms of like unequal roles and responsibilities. I think ultimately the most important thing is, do you find just incredible founders who know how to work with other people and understand that, to build a company that can last on its own two legs, you have to be constantly reinventing yourself and the management team and
Hmm.
the company's technology and the company's product line. And that might involve shifting roles and responsibilities across the founders or the rest of the management team. That might involve someone leaving. That might involve someone coming in net new. Uh, it, it it's it's fluid ultimately.
Hmm. And I think it opens up the question that I think I take for granted, and you certainly take for granted too. But the idea of venture stages and the idea that venture capital investments are very, now I would say, like prototypically defined around the stages of the company. And I was hoping you would give us a little overview of what typical VC stages are, because it goes back to this idea of de-risking and it echoes the fact that companies have to reinvent themselves, their processes, their corporate structures, their everything at each iteration of the cycle, and eventually exit at some point. um, this is like VC 101, but we haven't talked about it, so I'd love to hear your intro sem on it.
Yeah. So, conventionally speaking, there are a number of, stages or rounds that people use to describe um, the status of a company, right? So typically, a company like again, these are just very, very high level abstractions, and, we'll get into kind of like where they might start to break down. But a founding team with an idea, maybe you can call that a pre-seed stage opportunity. Um, a team that can maybe raise, a few $100,000, maybe $1 million, sell, I don't know, call it 5 to 10% of their company. to get off the ground. A team with some type of MVP, maybe a couple of uh, partnerships, business relationships. Maybe they're paying, maybe they're not. With a couple of current or future customers, might be able to warrant what looks like a seed round, right? Maybe raising somewhere between $2 to $5 million, selling anywhere between, again, 10 and 20% of the company. Uh, and then a company that has then moved on from that stage and has built something that actually looks like a product, right? A product just being some piece of software or some piece of hardware, or even a service that basically looks the same customer to customer and can be repeatedly supplied,
Hmm.
from customer A to customer B to customer C, right? Like that's the definition of a product. And like a Series A stage company has built a product and has what's known as product market fit, which is a very abstract term that I think people would debate, ad infinitum on what that really means. But a lot of people will basically crassly say that if you have $1 million in booked annual recurring revenue, especially if you're an enterprise software company, you basically have product market fit. And so you can, and that looks anywhere between, call it $5 and $15 million, certainly selling 20 to 25% of your company, and bringing on a board member. So creating an actual board of directors who basically govern, the company, and bringing on your first outside board director from that venture capital firm that leads that $5 to $15 million Series A to basically come in and help guide the founders in a certain direction. Um, and then Series B is, you've taken this product that you have product market fit, and you've started to basically build up a sales and marketing muscle and a machine, so to speak, where you can kind of convincingly say that $1 in produces Y dollars out. And that $1 in typically means if I hire one more salesperson, then I expect to get this much additional revenue over this time horizon. And hopefully that trade off looks really good. Um, and, therefore, the equity capital that I'm not new raising for a Series B, again, maybe selling, 10 to 15 to 20% of your company, is um, can be very predictably used to hire more sales and marketing staff, i.e., scaling up the sales force to repeatedly sell that product, grow revenue, but also potentially, invest a little bit more in research and development to open up a new product line, or open up a new customer segment, or, open up a new geography, do something else. And thereafter, every subsequent round you might call growth equity, right? A Series C, a Series D, a Series E. And it looks kind of to be more of the same as a Series
Hmm.
B, mostly focused on um, like TAM expansion opportunities, meaning new products, new geos, etc. Um, and then, being able to invest more heavily in scaling up your sales force.
Hmm. And Varun, this is super helpful, not just from the perspective of sort of financial, a position of investing, looking into companies, but also for founders who are sort of navigating their entrepreneurial journey. And this is a great way to think about the problems that they should be focused on at different stages of the venture. I mean, in the founder's journey, there are just so many knobs to play with. There are the space of exploration is so gigantic, and founders without the right guidance or without knowing some of these best practices that have been developed over time, especially for technology ventures, a la Silicon Valley style. That there's a process for this stuff. There's a set of expectations that are sort of implicit in the know-how of the journey. So you wouldn't necessarily be focused on optimizing your sales infrastructure as a pre-seed company, right? You wouldn't be necessarily in the process of thinking about hiring a lot of salespeople, not until you figured out that you're building something that people want to buy, and that's incredibly helpful. Um, and you guys do the earliest of stages. You do seed and pre-seed. Is that right?
Well, we're fairly multi-stage in that we'll lead your pre-seed, lead your C, lead your A, lead your B, even lead your C. For us, what's most important is starting out as early as possible, leading your pre-seed, leading your seed. Um, and then, basically, as we put it, collecting 1,000 data points on the company and the founders, over a period of time. And then using those data points and using, our product, which is trying to help the company, um, to sort of earn the right to double down, triple down, quadruple down into the best ideas, over the next, 10 years. I mean, as Brian Singerman from Founders Fund hilariously put it, I think on some other podcast, venture capital is ultimately about putting the most amount of money into the best companies at the best price possible. Um, and so, to be able to do that, I think you want to start off as early as possible. And sometimes you miss things, and having the ability to net lead a net new Series A is very valuable. But I really like getting off, starting to work with someone as early as possible, and then being able to lean in, just because obviously the financial rewards are there, but the intellectual and like emotional rewards of partnering over the long haul and seeing someone or some founders grow from a deck to like a
Hmm.
business that's
Hmm.
driving really meaningful value. Forget about the revenue they're generating, but driving really meaningful value to customers, whether that's individuals or enterprises or the government. It's incredible.
No, it's fascinating, and you're in a really cool position because you get to see this happening from multiple angles, right? You get to see very different kinds of value generated too. And okay, but there's another layer there that I think is interesting. That is, so Caffeinated has this unbelievable track record. So they make VC look like a different asset class in terms of the performance of their investments. But in general, VC is an industry where 90, as you said, 95% of investments fail. How do you feel about navigating a world in which you are building a relationship with somebody in a space where the space of possibility is so big and failure is a very likely possibility? How do you think about that? How do you engage with founders on the possibility of failure?
Yeah, I think one of the places where I'll start is I'm very fortunate to work with a gentleman named Raymond Tonsing, who originally founded Caffeinated and is one of the original solo GPs, and has been investing now for the past 15 years. And one of the really nice things of getting to work with someone who's been in the industry for a very long period of time is that, and someone who is very positive sum, and very much about human relationships with people, and understanding that it takes time for people to mature to a certain point, or sometimes it's just pure luck and you need multiple shots on goal in order to build something of value, is that you actually see empirical proof of um, the fact that sometimes certain founders will fail multiple times before succeeding. And sometimes they'll succeed and then they will have a not so successful outcome after, and then they will succeed again. I
Mm.
mean, I used to work at a company called Affirm, and the founder of that company, Max Levchin, famously, as like a dropout from UIUC, failed 4 or 5 times before founding PayPal. Founded PayPal,
Mhm.
nice exit to eBay. Um, helped found Yelp, was executive chairman of the company, founded Slide, which had an okay acquisition to Google, like you wouldn't call it a resounding success, and now founded Affirm, which is his most successful company. Um, there are founders that Caffeinated has backed, and I know many other venture capital firms that are um, you know just as positive sum and just as about relationships as we try to be, who have basically found that there are certain founders who um, like maybe their first endeavor was not a smashing venture-esque success, but their second endeavor was, or their third endeavor was. And so, you know, when I try to partner with folks, like I try to take that long horizon view of, is this someone who I think I want to be in business with over the next 10, 20, 30 years? Is this someone who I think is going to be building companies for a very, very long period of time? Um, is this someone who just like needs to, build technology companies, or is so strong when it comes to seeing massive problems that exist, and then also being able to put in the work to find, like a step-by-step path to get from, the problem state, I don't know, some type of nirvana state. Uh, like you can't just be an exceptional operator, right? You have to be really great at like finding really hard problems to even look at in the first place. So that's kind of like how I think about partnering with folks. I think educating, or not educating, but like working with founders under the specter of failure is an interesting question, one that I haven't thought about at
Hmm.
all. And I'm not really sure how to
Hmm.
articulate it, because I don't think, I think that there's a general assumption between both the founder and the investor that this endeavor is liable to fail, because you are
Yeah,
fundamentally
100%.
taking a venture-esque approach to build a technology company. And history suggests that, the vast majority of startups either, go to zero, or return a small amount of capital to the investors, or ultimately don't generate meaningful returns to the founders and the employees. I think that there probably is chaos or dissonance when you believe that assumption is held true by all parties, but
Hmm.
it's not.
Hmm.
But
Hmm.
that's a separate conversation.
No, and there's you're touching on the fact that in the venture style um, entrepreneurship journey, there is this implicit assumption that failure is okay. That we're sort of expected to go through the trials and tribulations, and like you're proving out meta stuff about you as a founder through the process of being a founder. That could be pay off in subsequent tries, which is very different from most types of endeavors. Like most types of industries, there's a very high reputational cost, and so I'm thinking of like back to the idea of a restaurant. A chef has a very high reputation cost. Fashion, same idea. Like there's a very high risk in terms of reputation. Whereas in the tech founder's journey, there's a bit more leeway there, and there's like an environmental like ecosystem. Reputational safety net that I think is unique to the space. But the other part that I was thinking about, which is before there's before it's a founder investor relationship, when you're assessing the relationship, and founder comes in with a wide-eyed vision of the future, hyper optimistic. They all their dreams are going to come true, and like everything's going to work out the way they want, and you're in a position where you have done your background research into the space. You know who else is in the space. You know what other sharks are swimming in the water, and so you have to very delicately have a conversation with them about how they're approaching the things that you see in their environment, without necessarily being like, yo, this is doom and gloom. Like, this is a tough uphill battle. And it was more around that I was thinking, how do you
Got it.
delicately manage the relationship with potential founders?
Yeah, I think you just have to be a little. There's an art around being polite but direct, um, and I think that you just have to be polite and direct. And one of the like one of the adages is founders at the earliest stages shouldn't worry about competition. Like you've probably heard that. I think founders have probably
Mm-hmm.
heard that a lot. I actually don't know who's the progenitor, or who like first said those words. But simultaneously, you want to be able to back someone who is so obsessed with the space and the problem set, and that particular industry, that they can talk about the competition. They can talk about the legacy incumbents in the space and what they do really well, what got them successful over the past decades, and where they're now failing, and where maybe pockets of opportunity might exist for this net new company to sort of wedge in and find an initial foothold before putting hitting the pedal and like trying to actually dominate the market. So it's again, it's like one of those things where there's a lot of uh, like there are a lot of adages that get thrown around. I think the
Mm,
venture ecosystem and the founder ecosystem, but at least for me, like I want to back someone who can tell me exactly who else is out there, what they think of who else is out there, what those people have done well, not just what they have done really poorly, why they matter today, why they don't matter today, if they're going to matter in the future, and why. Um, and um, I think that's just like the starting point of a really great relationship, because they're founders who are willing to kind of like, get in the weeds and talk in very specific terms about the industry, as opposed to basically just say everyone else sucks and, we're going to
mm,
dominate. Or my favorite is we don't really have any competition.
mm,
Um, because I
mhm.
think generally speaking, that's just not true. Like pick your favorite company and there's some legacy incumbent in it. Like one of my favorite activities actually is to basically think like, um, you know, uh, who are you going after in the public markets? Like
Mm,
like a good example would be Applied Intuition is a simulation company that I think has a private valuation north of $3 billion. Really exceptional founder, selling I think probably to automotive OEMs and also the Department of Defense. It's like who are you going after? Well, I believe Dassault Systems is this French multinational company that does a bunch of U.S. business and I think British business as well. And one of their heavy P&Ls is simulation. And the company overall I
mm,
think is probably north of a $40 billion public market cap. Um, but anyways, that's
mhm.
I just think that you have to be polite and direct, and you want to, at least I want to work with someone who is very honest about the competition and the legacy incumbents, and honest about where they think that they differentiate today. And you're not locking them into that differentiation, right? Like
Oh, totally.
it's these things are liable to change and liable to evolve. And um, but it's going to be hard to have a conversation on pivoting, or a founder thinking that there was a particular wedge and now they have to pivot into something else, if you can't even have a conversation at the very start when you're having a pitch about who the competition is and who legacy incumbents are. So it is a good signal basically about the founders and
Mm,
their, honesty and transparency. If you can have that type of conversation with them.
mhm. Like, how earnestly have you thought about this problem versus you have an idea that is unchecked against anything, and it makes total sense. There's another key relationship with VC that is your relationship to Ray and that mentorship relationship, and being able to learn from, as you said, one of the greats from Silicon Valley. Um, how does that work? How does the information sharing journey begin and evolve with someone like Ray?
Yeah, I can't speak for what it looks like at other firms and what it looks like for other mentors. For me, I joined Caffeinated to run a $20 million quote unquote scout fund back in 2020, and the handshake promise was, you know, uh, um, I'll teach you everything I know, and I'll give you the money to invest, and it's going to be great. And if it works out, it's on you, and if it doesn't work out, it's on me. Which are really shocking things to
Mm.
hear from someone, because basically everything is set up for you to succeed. Um, so that was the starting point, and Ray's the type of person who basically actually delivers what he promises. And so obviously there's a trust element that goes into it. Like
Yeah.
um, I starting out, I didn't earn the right to get access to uh, sensitive financials about certain very late stage companies that we've heavily invested in, or sensitive information of other kinds that might be lying around at venture capital firms. But what I did get was, you know, ask me any question you want, whenever. Here are all the investor updates of all the companies that we've partnered with. For the most part, here's my view of those companies, and then I could ask questions around, okay, this is an investor update point in time, but like, what was this company like 2 years ago when you first invested in them? So asking questions around like the trends, like, how has this company performed over time? What did you see in the company when you originally invested in it? What did you get right? What did you get wrong? Why did you double down at this point in time? Why did you not double down? Um, a lot of it was like, about the companies themselves, just like, how are they doing? And a lot of why and a lot of why not. Um, there was
Hmm.
also a lot of help around, one of the most important things I think in the industry is like finding a tribe of investors and angels who you tend to work with. Like, even though
Hmm.
it's a very competitive industry and it's very hard to work with even your best friends 100% of the time,
Hmm.
you still need to collaborate with people, whether it's actually collaborating on investments or it's just sharing information in terms of like how you view the market, how you view the opportunity set, how you think about certain types of opportunities, mistakes you've made, things that you've done well. And so the advice that I got was, find your tribe. And, that was really great advice just to get, period, but also having the resources and the freedom to go and do that, right? By, I don't know, being able to go to New York when I was still living in San Francisco, going to Miami Tech Week the first
Hmm.
year, where I actually ended up randomly meeting a couple of investors that I'm very, very close with, still to this day. Everything from that to actually seeding that network by introducing me to a couple of, other funds or other angels that he's worked very, very closely with. And then just seeing like, are these people that I, want to work with? Are they people that I get along with? And, also giving me context and not just saying, you need to work with this person because I work with this person or I have this relationship with them. It was instead, you should probably chat with this person. Here's my perspective on their work product and what makes them great. And then see if you want to work with them. Um, so I think the most important thing that, Ray gave me and continues to give me is freedom, advice, his Rolodex,
Hmm.
and just generally being a very responsive human. Like we text nonstop, we call nonstop, we exchange emails, we share information on what we're looking at or things that are happening. And it just helps build up context that if you're in the industry for longer than 2 years, which is where I'm at today, and like knock on wood, I'll continue to be in the industry for the next 10. Um, that knowledge, that compounding knowledge actually, helps you.
Hmm. No, certainly, as your friend, I'm really happy that you found this very unique situation where you're getting to learn from one of the best in an incredibly exciting space. Um, there's another thing too, that is, you started doing venture capital at a fascinating point in time to learn venture capital, which was in the boom of the early 2020s, and in a space where rates were, fluctuating in unprecedented ways, and the entire macroeconomic landscape was changing, and the entire sort of nature of human interaction was changing for a bit, with all remote, everything going remote and whatnot. And so I was wondering what some of your challenges have been, sort of navigating the landscape of VC as a newcomer to the field, and sort of in the context where, in the beginning of 2021, it felt like, there were a ton
Yeah.
of new funds that were popping up and a ton of new managers. What was that like, and what were some of the most difficult parts of it?
Yeah, it's a great question. I'll start out with what has not changed as tech has kind of had a downturn since
Hmm.
2022 and interest rates have gone up. Like, I think the industry is just very competitive, and that competition is here to stay.
Hmm.
And the competitive nature of the industry will probably only increase even after you control for um, certain funds potentially being washed out as limited partners feel a lot of pain and decide not to invest in net new managers or re-up as much with some of the more emerging managers that they back. uh, I just think competition is here to stay, and it's always a competitive industry. For me, starting out in the end of 2020, right, with this $20 million pool of capital, with sort of guidance around, hey, maybe you can think about investing within these valuation ranges. Um, maybe you kind of invest at this clip, meaning this number, this make an investment maybe every other month. Obviously, all of that being very flexible, but also most importantly, like the way to think about opportunities, right? Like the best companies take a long time. Like Figma's taken
Mm.
like 10 years to get to where it's at and probably wasn't revenue generating for the first 4 years. And it's not like they were raising, a number of subsequent, rounds of capital within those first 4 years. The most stressful part for me was trying to find my bearings with this guidance around how long it takes for companies to build themselves, to build their teams and build their products and build commercial relationships, and squaring that away with the rapid pace of capital deployment that happened often into the same
Mm.
companies within that 7 month time frame. Like there were companies out there that would raise a seed, and that seed would be a very large seed round, and then maybe a couple of months
Mm.
later they would raise a Series A, or maybe they raise a Series A, and then a couple of months later they would raise a Series B. And I would go to events where there were other investors, and as part of trying to find my tribe, and they would talk about, well, I was able to invest a small amount of money into this super hot company, and then it raised a markup or like a subsequent round of capital 2 months later, and now I'm marked up, and like now everything's amazing. It honestly stressed me out a lot, especially when you
Mm.
combine that heat seeking kind of like discussion,
Mm.
or discussion of that heat seeking
Hype.
activity
Yeah.
with hype, with a lot of chatter and noise as I was trying to figure out, how to do my job really well, with the sense of you need to have your own brand, you need to be tweeting, you need to be writing blog
Mm.
posts, you need to have a ton of followers. Like a lot of that chatter also stressed me out, right?
Yeah.
Um, so now fortunately, like, I don't think I made out of that scout fund like investments that were I mean, everyone will say this probably, like very like hype driven. Um, but it was a very stressful period of time to just find my bearings when there was all this chat and all this noise about you have to do venture a certain way, and you're doing it right if you're getting markups a month later or 2 months later, and having to do it that certain way was very contrary to the way that I want to be an investor. And having markups happen in a very short successive period of time is very contrary to how I viewed startups actually taking. Like I used to work at Affirm, and Affirm notably was wandering in the desert for like 2 years, 3 years
Mm.
before it built the current product that it's super well known for. And then it took 7 more years, 6 more years for it to scale that product to a point where it could, kind of like be a public company that has like a stable market cap. Um,
Mm.
so I don't know if this answers the question, but uh, the flip side though is, I remember chatting with um, an investor who left investing to join a company as, as a builder, and they spent 5 or 6 years investing, and prior to COVID, prior to 2020, prior to kind of like the hype years or hot years, and they told me that they're actually envious of investors who are investing in 2020, 2021, because
Mm.
over that 4 or 5 year time frame in which they were investing, um, they weren't really able to invest that much. Whereas had they been investing in 2020, 2021, they probably would have made many more investments in a shorter period of time, and potentially learned more.
Mm.
So it was a really interesting comment as like
That's
a
fascinating.
as a counter to what I had said, which was no, 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 let's slow this thing down because I feel like everything should be slow. Uh, and so it's good kind of like counter positioning to the way that I viewed my time.
No, and it's fascinating because there was this sense, and this is like when interest rates were at zero, that everything was, all the investment, so much money, so much institutional money was going into these riskier asset classes, and there was this what I felt was a very dangerous game of those markups. 6 months, 6 month cycles between fundraising, and it felt a little irresponsible. Like, just because of the rapid pace of everything that was changing, and not just in the in the venture world, but in general in society. Like, everything was changing, new information about COVID, we were updating our priors the whole time. And so I felt the exact same thing that you felt in VC, where it was like this sense of like, wait a minute, are we really latching on to the metrics that we, or the the understandings that we had previously agreed on about what these stages mean? And I think it'll be really interesting to see the aftershock of that, in like a couple of years, when, like, companies have to grow into the valuations that they raised at, and in a very different economic environment, right? Like, and so much uncertainty in the world too. So it'll be really interesting to see how it all plays out. But the point about getting more reps is an incredibly valid one, right? I think, like, it just like, it forced you to put yourself out there, to be in, to hustle out more, and like have these discussions, um, and learning is one way to put it, but, to fail also, right? And like, learn through negative feedback or positive feedback, what it really takes, when your skin is in the game. So that's really interesting. What have some of the highlights been uh, in your tenure?
Great question. Some of the highlights. I think you know, for me, most of my all my highlights basically have to do with people, right? Um, so it could be meeting new people, and as I mentioned, Tech Week in Miami, April of 2021. I was going to a dinner that my housemate invited me to, and I happened to be sitting next to this gentleman named Ashe Sangvi, who is an investor at an amazing firm called Haystack, and he has a very similar relationship to the founder of Haystack, Samil Shah, as I do with Ray, my partner at Caffeinated. And Ashe today is one of those investors that I just speak with nonstop, who I find myself learning from an immense amount. And so that serendipity of meeting him in Miami through someone else was certainly a highlight. I think another highlight was, not to kind of like talk in specifics, but there was one company that Ray and I had sourced, and Ray and I led the seed round of, and I built a very strong relationship with the founders, and just saw like the severity of the problem that they were solving, um, and the quality of the product that they had built, and the insights into the market, and commercial dynamics, and the detail in the product, as well as the insights into like the active commercial engagements that they were kind of managing. um, they, when they went out to raise their Series A, um, it it was quite an ordeal. Like, I spent probably a few hours almost every day speaking with the founder for 4 or 5 weeks straight, debriefing about every session, about the nuances of every conversation. And then it, and a lot of those firms passed because they just didn't see, what we saw in the opportunity, and what we saw in the founders. And then actually the one firm that we really wanted to partner up with us put in a ton of time researching into the company, and spending time with the founders, and then saw the exact same thing that we saw in the company, and ended up going all in on the Series A. And to me, that was probably, besides like meeting new people who have become very important as part of my kind of like job, it's moments like that that are the most rewarding. And it's not because oh, this company now has a higher valuation in the private markets. And yes, it is. They have more capital now to do more of what they've been doing, and to accelerate. But it was this sense of also, you know, being happy for the founders, like being just absolutely thrilled for them that, someone else out there who's much more experienced than I am, and also very, very thoughtful, uh, believed in their vision as well and was willing to put serious dollars behind it. And then selfishly, it was also helpful for me because, um, you are also, crazy for believing in an opportunity and believing in a team. Maybe not as crazy as those teams believing in themselves and deciding to put all their eggs in one basket. Uh, but then having that other firm come in that's incredible, um, that you can partner up with, um, it's intellectual validation,
Mm.
if anything else.
Oh,
And
that's
having
awesome.
someone else join the crazy is incredible.
No, and you're in the industry of making dreams come true, right? Like, so you're seeing stuff manifest and like actually start shaping, the world that we're in, and I mean, it's just incredibly exciting. I have one last question for you, which is, what are some of the verticals that you've been most intellectually excited about since you've, been in VC?
Yeah. Generally, I'm not thesis driven or thematic. And
Hmm.
generally, enterprise software, fintech, healthcare, which includes therapeutics, are our bread and
Hmm.
butter. We've got a budding defense portfolio, um, with, uh, just because I think that there's some incredible, like companies like Palantir and Anduril have sort of proven that there is a way to basically build a massive, highly impactful, mission oriented organization that can generate very significant revenue selling purely or in part to the Department of Defense, which previously was sort of the domain, of the legacy defense primes. So that's an area that I find generally exciting, though. You kind of always have to keep in mind that to generate significant revenue selling to the Department of Defense, you literally have to change laws like the annual defense budget,
Hmm.
um, to generate lots of revenue. And the person who's writing that law is different from the person funding your capability. And that person's different from the person using your capability. And that's different from the
Hmm.
person maintaining your capability, and giving feedback on your capability. And so, it's like, well, like I find defense exciting. And I think that, we found some incredible opportunities in it. But it's also probably one of the hardest verticals out there. And, you know, like we have a shutdown right now that's affecting,
Hmm.
a lot of defense companies' timelines around getting, congressional revenues. So, um, I, I'm I'm always attracted to folks who are trying to rebuild something from the ground up. Like we have a company
Hmm.
called Saronic on the defense side that is trying to rebuild the United States Navy from the ground up, starting with these small autonomous boats that are highly capable, highly dispensable, attritable, you know, and ultimately can really help us, uh, reattain superiority in the maritime context, especially in, the Pacific. But I'm
Hmm.
also, an investor in a company called Federado, which is, an enterprise software company in property and casualty insurance, which years in advance of State Farm and Allstate retreating from homeowners insurance because of, wildfire,
Hmm.
um, kind of identified that the industry is fundamentally broken, um, and needs to change in order to allow carriers, and carrier like entities to, um, underwrite the same risks that they're underwriting, or underwrite the same lines that they're underwriting today, but accommodating the new risks that are coming on in the form of flooding, wildfire, cyber,
Hmm.
and inflation. And so, I'm whatever industry it is, I'm always
Hmm.
attracted to founders that have identified like a nexus of problems that they think are responsible for the woes of that industry. Um, and they have a vision of the end state, and they can show a step-by-step plan of how to get from the broken state to the end state. And so that's always what I find the most exciting. And if I can find an incredible team that can articulate that in every industry, and I can find a way to back them, I'll be a very, very happy person.
That's amazing, and I wish you more and more happiness, friend. I mean, like it's awesome to see you in your journey, and always a
Thank
delight
you.
to have these conversations with you. I really enjoyed it.
Thank you, sir. Enjoyed being here, and thank you for the questions and the opportunity.
You got it. See you soon, my friend.
See ya. Bye.